Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I'm going to be doing a very quick update on Leggett and Platt. I covered this stock several months ago on request of a subscriber here at the Cyclical Investors Club YouTube channel. And I went back and rewatched the video. So the stock imploded today. Basically, it's down almost 30% from here. That's not showing up on the fast graph. This will be updated tonight. I think it was down around $13 a share. I went back and watched the video just because I had a lot of questions today that people were asking me on multiple platforms. And so I thought I'd put out an update after I took a look at it. And so I went back and watched the video, which was really actually a pretty extensive video after I rewatched it all. And I to make sure that I just didn't say something totally wrong that I'm about to say now, that contradicts what I'm about to say now. And I didn't. I think it's a really good video. So I'm going to put that link in the bottom if you're interested in kind of what I was thinking when I was looking at it back then. But basically what's happened is they announced their dividend cut, which I did talk about in the video. And at one point I was like, I might be willing to come in if they cut their dividend because the stock would probably take a big dip. And then that has actually happened now. And so I thought I'd take a closer look because it's not really one that I have traditionally tracked. And other than as a dividend stock, I did track it because it was a dividend king until this cut. So my thoughts now are it's definitely cheaper. Let's see. The one thing I would say it's a combination of three things that is keeping me from buying the stock. Now, I think if a person really had done their research at the time of my last video, and they decided that they really liked the business and it would come back, now is if you're going to buy it, now would be the time. Now, for me, I'm going to explain. I still am really I was on the fence really with that video, and I still am because I do think it's cheap enough now that you could probably, if they do recover, even if it takes 5 or 10 years, you could potentially do really well with the stock. But I'm going to show you why I'm not going to do that. Now, I think, let's start with the metrics really here first. So this is what I did was I created a Y chart with their revenue, their annual revenue over their total liabilities. I did this for their debt too. Actually, let's start with the debt, the long-term debt. So if you just take their long-term debt, now if you think of this as a deep cyclical business, which it definitely is right now, I think it should be treated that way. You can't really look at the dividend. It's been cut like 90% or something. So basically eliminated. Earnings are way in a deep down cycle. They were kind of on the edge of a deep down cycle during the Great Recession. Earnings were. So I think it definitely needs to be treated as a deeply cyclical business and a deeply cyclical stock now. So one of the things I do with deep cyclicals is I go back and I look at the previous downturns. I did this in my last video as one of the ways to kind of analyze it. And then I look at the current downturn. They haven't really gone through a downturn like this since like the late 70s or early 80s. I did have a chart that went all the way back there, and they have been down this low once before off their peak. I think it was the early 80s recessions, but not since then. So one of the foundational kind of thoughts behind the deep cyclical investment strategy is that if this cycle is similar to the previous cycles, then we can expect the stock price will recover in the same way that it recovered before. But I have a whole checklist that I go through before I actually buy stocks with that strategy. And one of them is I want to see what debt was like relative to the previous cycle, because if there's higher debt levels, that can slow down. Even if they do recover, it can slow that recovery down a lot, potentially. So that's one of the things that I wanted to look at and compare it to the past. So I set up, this is just their revenue over their long-term debt here, like in the ratio of that. And really what I want to see is how does the ratio now, because this isn't this doesn't have anything to do with the stock price decline. So the typical one people I usually look at when I'm on the fast graph is market cap to enterprise value or total enterprise value, and then I see the difference between those, and that's my initial kind of look when I'm doing a normal valuation for an earnings-based stock. But when the price changes, that lowers the market cap, and it can kind of make that number look pretty big. So it is dependent somewhat on what the price is doing. So when it's crashing, it can be a little different. Just like with when earnings crash, it can screw up PE ratios. So this is a way to kind of look at it in a more steady fashion, where you're looking at the revenues and you're comparing that to the long-term debt. So the way that I would say this is, the revenues are 2.3. This won't have this latest earnings report, so this might actually be worse. It'll take a couple days usually for Y charts to get that in there. But going into this, revenues were 2.3 times higher than their long-term debt, total long-term debt. And what I want to know is not so much the level, is how does that compare to the previous down cycle that we would be comparing it to, which is the Great Recession, which is right in here. This varies a little bit each year, but basically it's about 4, right? And now it's getting probably going to be closer to 2. So this ratio is about double, which is, or half, I guess, which is bad. That means you have half as much revenue compared to your long-term debt as you had during the Great Recession. So that's a warning signal, or a potential signal that the recovery period during this time will likely be slower, even if it does recover, than during the Great Recession. And the slower recovery is really the less money you make on a deep cyclical, because usually you're trying to buy near the bottom of the cycle, you're trying to sell, at a predetermined level when it recovers for me, but more close to the top of the cycle. So if that predetermined return level that you want to get, if it takes you 10 years instead of 5 years, your compounded returns are not going to be as good, right? So and it's scarier the longer you have to wait, and you lose less confidence the longer you have to wait. So ideally you want these recoveries to take, my goal is less than 5 years, like 5 years or less most of the time. So that when the debt levels are relatively twice as much, that makes it harder to do. We see a similar thing if we just use total liabilities in revenue. So if we take the total liabilities right now, again, going into this earnings, revenues are 1.4 times higher. And we just, again, the level isn't so much important as how does it compare to back during the Great Recession. Actually, during 2009, they got a little lower in 2010, but still, we're looking at almost double, maybe not quite double, the total liabilities relative to the revenue. So I think that it's hard because the stock is really cheap, but I think I wouldn't be super confident that it will recover the same way that it recovered back in during the Great Recession. So if we look back here, we can see if you bought at the initial stages somewhere in here, 2008, and let's say you held to 2013, you would have gotten a double. So that would be kind of a standard cyclical kind of investment. Maybe you bought like 50% down, sold after 5 years or 6 years, and you got a double. That's not too bad. In this situation, if it takes 7 years, assuming that they recover, if it takes 7 years or 8 years, your returns, even though you might get 100% return, are not really going to be worth the risk. That's when the debt comes into play. The other thing that kind of really tilts me away from taking this chance, even though it definitely looks a little juicy, is right now interest rates are at 5%, over 5% actually. And they have, so far, inflation has been strong enough that the Fed announces today probably what they're going to do, and Powell might even be in this press conference. Not yet, a couple hours. But basically, interest rates are still high. During the Great Recession, interest rates got cut to like 0/below 0. And that also will aid a recovery in a cyclical business like this. We don't have signs that that's happening yet. So, again, even if it happens eventually, you got to think we have another minimum 6 months or something until the economy maybe is bad enough for serious rate cuts to happen, and then for that to totally affect the economy. So now you're stretching that time period out even more. So I mean, if I had to guess with the information I have right now, you really should maybe have like a 10-year recovery in mind. You toss in to the mix that they do at least have some manufacturing in China. I don't know. I just peeked at their annual report before the last video that I looked at. There might be some China exposure there too that could have some geopolitical risk. I don't really know for sure, but it'd be worth reading up on that if you were considering taking a chance on the stock. So I'm going to hold off on this one, but you know, it's one of those that could bounce back quickly for a while too. Whenever you get like a 30% flush out, it's going to attract some bottom pickers, right? But I'm more of like a medium term investor. I know I made a Globe Life video when it crashed on a short report, and there were a few comments that were like, "Ah, you missed this one," and it's like, well, not really. I wasn't really trying to predict what would happen in like 1 month time, because I don't really think I can do that. These are more fundamentally based, medium term, 2 to 5 years is kind of usually where I'm aiming for analysis. So yeah, it could definitely bounce back, 50% between now and then when something really gets flushed out like this. The value investors will start coming in and maybe picking up a few shares. But for me, over the medium term, I think I'm just gonna hold off on this one for now. If the Fed cuts rates, we don't have seem like we're having a bad recession, and it looks like things are kind of recovering for these guys at that point, maybe I'll come in. Maybe they could refinance some of their debt lower or whatever, and then as business is picking up, might be more attractive at that point. I think I'd feel a little better. I like to have pretty strong confidence in deep cyclicals when I step in and buy, because if a stock goes from 80% off its high where it is right now to 90%, you don't lose 10%, you lose 50%. It's like buying a $100 stock when it was at $100 at its peak. If you buy it at $20 and then it goes to $10, you don't lose 10%, right? You lose 50%. Your $20 goes to 10. So that's important to keep in mind as well. And I think I'll just leave it at that. If you definitely check out the other video, and if you have any questions, put them in the comments. If you found this useful, hit the subscribe button. I'll see everybody later. Bye.